Tech is back because tech is working and tech is empowering the digitization of America. That's not changing. Every time we get the story that we're going to roll out of tech into value, it works for 3 or 4 days, and then we go right back to what's really happening in the economy, which is tech platform driving digitization, not only domestically, but globally. It's happening all around the world, and these companies are the ones that are empowering it, so that investment theme is going to be strong right through 2021.
Couldn't have said it better myself, Kevin. Hi, my name's Fernando, and this is Financial Firefly. That was multimillionaire investor and Shark Tank entrepreneur Kevin O'Leary explaining his thoughts on the economy, the current happenings this week, and what he's doing. He's essentially saying that all growth in the economy is through tech, no surprise, and that we're going to war with China. We have been in a trade war, but he's going over his portfolio with a fine-tuned comb because he sees impending risk that he wants to avert now rather than when the fires really start, and not the fires in California. Today, we're going to be touching upon these tech stories, mainly Tesla, my main growth thesis, and Apple. These two stocks are just on fire recently. Spoiler alert, they're most of the growth in the economy. And by economy, I mean stock market. They have shot up. Tesla has risen 50% in the last week since announcing a stock split. Apple also announced a stock split earlier this month, has risen 20% plus. And Tesla, today alone, is up 3% after 4 consecutive days of trading higher than 5%. Kind of unheard of what's going on, but it just goes to prove my thesis that Tesla is really endlessly innovating, and they're going to totally disrupt multiple industries and sectors that only right now Wall Street is starting to wake up to, and they're still kind of blind to what's going on. I used to own up to 24 shares of Tesla. I do not. I sold them. Me, in my infinite wisdom, sold my 24 shares of Tesla because I was bored. I wanted to learn. I wanted to trade, and investing back in the day for me, which was only 2 or 3 years ago, was really a quick growth story and kind of a get-rich-quick scheme, but it really was a learning experience. And parking my money away for a 5-10 year return, I just kind of was bored and didn't want to wait that long. Long story short, it was a mistake. And I kind of wish I still held it, but at the same time, I would not have gained the trading experience that I do now. Without further ado, let's get into some of the news of this week surrounding Tesla and Apple, followed up by a quick recap of my dividend growth portfolio and what happened this week, with it heavily being related on tech and Tesla, and kind of playing into my bull thesis of tech and innovation growth leading the way forward for the decades to come. Hey guys, don't forget to start your investing journey by claiming your 2 free stocks from Webull, one of which could be valued up to $1,400 when you deposit $100 or more. Possibly 1 free share of Apple, Microsoft, or Facebook when you sign up with Robinhood, and your $10 when you sign up and deposit with M1 Finance. Comment down below to tell me what you get. Links in the description. Let's get back to it. First article here. Tesla has soared more than 50% since announcing its stock split last week. Can you imagine a company announcing a stock split, which adds no inherent value to the stock, mind you? It's just taking that value and dividing it by that factor that you're splitting it. So really a $2,000 stock, when a 5-to-1 stock split becomes 5 shares of $400 a piece. Still $2,000, just 5 stocks. Tesla, on the other hand, has skyrocketed since this announcement. And it's really no surprise because, historically speaking, stocks that announce splits do, on average, 12% better than their counterparts in that time frame. Tesla, on the other hand, has done significantly better than that. And a lot of reasons go into this, but stock splits mainly give access to less established, accredited, and less sophisticated investors, let's say. But there's been so much hype and motivation around getting in this stock and it changing and truly disrupting the industry that people at a $1,500, $2,000 price point, it was too high, it's too costly, it's too risk on, the time frame and rate of return is too long for them, so they just don't want to get in. Here comes Elon Musk cryptically announcing on Twitter on 8/21 on 5/1 an 8-something stock split. On Twitter, the time frame matched up, cryptically announcing this stock split of a 5-to-1, and lo and behold, retail investors flocked. They are flocking in droves to this stock, and it doesn't seem to be ending. Wedbush Ives, a very well-known investment firm, announces Tesla will keep rising despite haters. Well, I agree. I think it will. It doesn't mean it can't drop, and honestly, it kind of should. But there's so much hype and there's so many things piling onto this stock, not even mentioning potential to be included in the S&P 500 now that they have had 4 consecutive quarters of profit while selling only EVs that no other auto manufacturer can even come close to stating. Tesla's stock set to extend gains above 2,000 while peers and broader market are falling. Yeah, so things are not looking well. Jobless claims are still coming in. Isolated pockets of housing and markets are doing really well, but as a whole, still what's happening to all this deferred rent and all this deferred revenue? Yeah, we've pumped trillions and trillions of dollars into the economy, but we're still in debt to everybody and their sink and their mother. Tech's Magnificent Seven are worth $7.7 trillion. You heard that correctly, $7.7 trillion. Now, these stocks include Apple, Microsoft, Amazon, Google, Facebook, and now Tesla and Netflix. So all those companies are worth $7.7 trillion. And there are only 8 companies now that are bigger than Tesla. If we continue this article by CNN Business, the only stocks that are now bigger than Tesla are Walmart, Apple, Amazon, Microsoft, Google, Facebook, Berkshire Hathaway, which is like a couple $100,000 right now, Visa, and Johnson & Johnson. I think Alibaba is part of that list, but that's not an American stock, so we're not going to count it. But it just goes to show you the power of big tech moving the economy. And Kevin O'Leary really, he's not lying when he says this is a tech story. This is a growth story of innovation. And the only true things that are adding value are tech, not consumers, not housing, not energy, not cannabis, unfortunately, nothing. Tech is the way up. Some might say that this needs to be corrected. I myself think that this is warranted, but I do think that the pace is a little fast. So let's just dive into what's been happening to my M1 Finance Growth Dividend portfolio that closely tracks these tech stocks. So here we are, my passive income M1 Finance Dividend Growth portfolio sitting at $10,612. I recently got this portfolio above 10 grand this week, hitting that milestone significantly earlier than I thought I would, and that's after reallocations into tech, out of a lot of the traditional plays, out of high yield, and fully in my innovation thesis. And so far it's paying off very handsomely. So we are in a massive period of growth and speculation and hype and innovation, but that I think is the trend going forward. Unless you're innovating, you're dying. And so far that seems to be the case in finance, in tech, in cannabis. These are really the major, and software, these are really the major growth industries. If you can digitize it, you can scale it and grow it exponentially at scale with almost no limit at zero cost. That's the power of digitization and software. It's trading electrons, not atoms. It's trading software, not hardware. So if you can softwareitize or digitize a business, that's a huge, huge growth potential. Because what happens when you create something online or digitally? There's a little feature that's called copy and paste. Copy, paste, copy, paste, copy, paste. Times a trillion and you're a trillion. Simple as that. There are a little bit more nuanced, of course, but it is that is really the overall story here. So diving into my dividend portfolio, ARK Invest 30%, Tesla 20%, technology 10%, renewable energy 10%, Apple, Microsoft 10% each, followed by a little stabilization of consumer, finance, real estate, and cannabis. Tesla, the main earnings this week, I'm already up 97 money weighted return. It's a really complicated formula, but if we just go into the last week here, I'm up 7.6% in the last week. That's nuts. I literally just got above 10 grand and now I'm almost at 11 grand and I only deposit $25 a week into this thing. I would like to do more. I just don't make that type of money. So right now, I just made $151 of capital gains in the last week. These are not realized gains. The only realized gains are the earned dividends of $2.61, which I am very happy about, because if we go back to all time, I actually just passed $100 in dividends. My first $100 in earned dividends in 8 months. I am very happy with that. So we'll see the compounding effect of this over time. I do have a pretty stable job, so hopefully I will continue to get raises and continue to save more and more income and not fall prey to the lifestyle inflation trap where thereby you earn more money, you spend more money. That's how you stay poor. That's how you live, work, and die. It's not how you live, have fun, and die. So I don't want to do that. I want to get out of the rat race. This is part of it. And kind of crazy. So 50.82% all time. That's not really the case. I've invested $8,000, $8,495, and I've gained capital gains of $2,200. So that's really only, I want to say, 25% return, but because it's a money-weighted return, I think it has to factor into the time frame that I've invested this money, and it takes into account that average time that money has been sitting there working, and then it gives me this 50% number, which is kind of ridiculous that I've gained that much in this amount of time. You're not going to gain that with your traditional savings account. No sirree. Just a quick aside here. I happen to own, at one point, 24 shares of Tesla. I was looking at my trading history here when I got bored, and I actually had a limit sell of 24 shares at Tesla at $232. I sold 24 shares of Tesla at $232. Call me a fool, call me naive, I deserve it all. It doesn't make any sense what's happening here, but it makes all the sense in the world. In any case, like I said, this was back when I wanted to learn trading more. The rate of return was not as great as I would have liked it to be, as it never is for anybody. And so I sold it and I started trading. And I learned to trade okay. I made some pretty big recession plays back during shorting the airlines in March. And I didn't execute those sells, those puts. I didn't sell any of them. I held on like a pig. And they all expired worthless, so I lost around $5,000. And then I learned to trade again without getting too greedy. And this is me building back up to where I was. I had a nice little fall here. I got Vega crushed, I.R.E crushed, where my time decay destroyed some of these calls after earnings. But I held on, strong-handed it, back up, and now I'm essentially where I was at my highest peak, less $3,000 or so. I'm very confident I'll get there. It doesn't look too good that I have all these negative returns on the side. This was when I got I.R.E crushed, and to be honest with you, I was a little quick-palmed grabbing these. I got bored during work one day, and I picked up a bunch of contracts, but I didn't look at the technicals, and I got burned. So look at your technicals, evaluate your momentum, and don't buy in unless you have a good strategy for what you want to do. If you're buying a put and it's going down, great. Make sure it's within your premium that you want to pay for. Rounding out this week, let's just get into an interesting story of a young man has received 7,000 shares of this holding. Now, this is going to split on a 4-to-1 basis to 28,000 shares. It's worth roughly $3.2 million with a 0.68% dividend. At that rate, that's a $22,000 lifetime guaranteed dividend unless Apple goes under, which I really don't think they're going to be going under anytime soon. So what would you do? Hold on to it? Sell it? Wait till after the split? Sell 21,000 shares? His grandpa bought these shares back in 2003. He's held on to them all this time. So this guy is asking the question, what I need to know is, should I move it around or keep it rolling in Apple, whose screen name happens to be Big Weed? Well, Mr. Weed, I think that you should hold on to some of it. It wouldn't be unwise to hold on to all of it, quite frankly. Your grandfather strong-handed it for 20 years for you, almost 20 years, and it's done pretty well for itself. And I am going to say that it's going to do well for another 20 more years. So yeah, you can hold on to it, but somebody made a very good point that if you sold all of this and put it into AT&T with a 10x dividend on that 0.68%, AT&T pays a 6.8%. You would be getting, rather than $22,000 annual dividends, you'd be getting $200,000 in annual dividends. So, there's a lot you can do with this money. Personally, I would hold on to it till after the split, see if it's going to skyrocket, and momentum trade it. I would trade it, set aside a certain portion, don't touch it, but then play with another portion and possibly sell another, right? It's all about diversification, reducing risk for your risk plan and your strategy. So, there's a lot you can do in today's market. Tech is ruling the way. Kevin O'Leary has proved my thesis out, and I hope that you guys have your own thesis and strategy to adhere to, and it's working out for you. Let me know down in the comments what you guys would do if you inherited 7,000 shares of Apple, soon to be 28,000. And I hope you guys enjoyed this video. This has been Fernando Nazario on Financial Firefly. Be sure to smash the like button, hit the subscribe button, and destroy the notification bell. Catch you later, Fireflies.